Over to you, Jackie.
Thank you, Julia. Thank you, everyone, for being here today and listening to this presentation. I'm very happy to be able to speak with you with respect to estate planning. This is something that is extremely important and something that not enough of us are actively involved in and actively putting a plan together. So the idea today is my presentation's about 40 to 45 minutes in length, and I'm just going to take you through things to consider as you're putting your estate plan together. So then there'll be lots of time at the end for any questions that you may have. So this is my standard disclaimer. I am not here to replace advice that you might be receiving from lawyers, accountants, any sort of tax professionals. My role here today really is just to provide you with information and to get you thinking about how you would like to structure your own estate plan and things that you should be aware of as you're going through that process. So the first thing that we'll look at today is working with an advisor to set realistic goals. So this is working with someone like Cherry and explaining what you want to accomplish in your retirement. What's important to you? Do you want to travel? Do you want to move so that you're closer to children or grandchildren? You need to make sure that your advisor is aware of what you're trying to accomplish so that your plan can be structured accordingly. The next area that I'll talk about is consider the tools to fit the situation. So when I'm talking about tools, I'm talking about wills, powers of attorney, trusts, and how all of these form part of your overall plan. So today, the main 2 points that I'll be covering are these 2 points here. But I'll also talk to you a little bit about choosing the people to speak for you. So who do you want your powers of attorney to be? Who do you want your executor to be? And then I'll give you some ideas as to why one individual might be better than another. Throughout this entire presentation, you're going to hear me talking about communication, and communication is key. It's really important for people to understand what you're trying to accomplish as far as your plan is concerned, because then the chances of there being issues and people contesting your will are going to be less if people understand what you were trying to accomplish with your plan. And then finally, I'll just talk about keeping your plan up to date and how you need to make sure that you're communicating any changes that are happening in your situation to Cherry or any other professionals that you have working with you. So when we're looking at working with the advisor to set realistic goals, I think a lot of us are looking to minimize tax. We want to pay the least amount of tax that we can. And essentially at the time that we pass away, there are 2 areas where there are going to be costs that are going to be involved. So the first is with respect to probate. So there's a fee that is that applies as far as probate is concerned. And I'll go into a great amount of detail a little further in the presentation with respect to probate. Another thing to consider is the income tax that we have to pay at the time that we pass away. So essentially, when we pass away, we're considered to have sold all of our assets on the day that we pass away. And as a result, this can translate into a relatively large tax liability. And that's why it's so important to work with an advisor, work with someone like Cherry, so that you can work at minimizing that tax. One way that can be done is by transferring assets tax efficiently to beneficiaries. So for instance, if you have a spouse, generally you want your spouse to inherit your assets because your spouse is able to inherit those on a tax deferred basis. So it's only when the second spouse passes away that tax liability would apply. You also want to think about who do you want your survivors to be? So who do you want the beneficiaries of your estate to be? And that's really important. And it's completely up to you as to who you would like those individuals to be. Generally, we find it's spouse, children, grandchildren, nieces, nephews, but this is your plan and it's completely up to you as to who you would like to have benefit from your estate. So if you have a close friend or a neighbor that you want to include in your plan, this is your plan and you can do whatever best suits your particular needs. Another area that we find a lot of people don't think about is a business. So if you happen to be a business owner, right now you might be very focused on running the business day to day and not really thinking about transitioning that business to another individual when you decide that you're ready to step away and retire. And that's something that you should be considering. Is there someone that you're mentoring? Is there somebody that you're bringing up to speed as far as that business is concerned, to ensure that when you're ready to step away, that individual can step into your shoes? One area where I hear time and time again as to why people do not put wills together is because they have minor children and they don't know who they want the guardians of their minor children to be. And I hate to say it because I know better, but I actually found myself in this situation. Essentially, my husband and I had chosen someone that we wanted as the guardians for our children. And we had asked those individuals if they would be the guardians, and they agreed and were very enthusiastic. And then before we had our wills drawn up, we really started watching the way that they were raising their children, the way that they interacted with their children. And we realized the way they were raising their children was not how we wanted our children to be raised. So as a result, we decided not to put our wills together because we didn't know who we wanted our guardians to be. And it took us about a year to find another guardian that we could both agree on. I have to tell you, that was one of the most stressful years of our lives, because anytime the two of us were alone, we were terrified that something would happen, like us getting in a car accident or something like that, and that the people that we'd originally asked to be the guardians would end up getting our children. So it is an extremely difficult decision, there's no question, but you don't want to not have a will in place and not go through the process, because the decision's never going to be easy. No one's ever going to raise your children the way that you do. You're never going to find a perfect guardian, but you don't want to not put your will together because of that. Now, when we're talking about transferring assets tax efficiently, one great way to get money into hands of beneficiaries quickly and tax-free is with the use of life insurance. So you can have an individual as a beneficiary of a life insurance policy that will pay out directly to the beneficiaries. Because it does not form part of your estate, it would not be subject to probate, and it gets into the hands of those beneficiaries very quickly. Because a lot of people don't realize that a simple estate takes 1 to 3 years to settle. More complex estates can take 5 or more years to settle. So that means that those assets cannot be inherited by the beneficiaries until the estate has been settled. So it's really important to make sure that if there are beneficiaries who need the money in the estate to live, you may want to have insurance policies that pay out to them so that they have money that they can live off of while the estate is settling. Another great way to use life insurance is to have that pay out to the estate. And the reason why you would do that is, as I mentioned, there's a very large tax liability that happens when the second spouse passes away, because everything is considered to be sold on the date that we pass away. So by having life insurance pay out to the estate, that life insurance money can then be used to pay those tax liabilities that happen within your estate. When you're looking at your registered assets, generally you want your spouse to inherit your registered assets, because your spouse is able to inherit those on a tax deferred basis. So it's only when the second spouse passes that tax liability would hit. You also want to generally have a beneficiary designation on those accounts, because then those accounts pay out directly to the beneficiaries. They do not form part of your estate, and as a result would not be subject to probate. So that's something to consider as well. What a lot of people will do as well is gift money prior to death. because if those assets don't form part of your estate at the time that you pass away, then they would not be taxed in your estate, and they also would not be subject to probate either. Now, the only thing I would say here is I would caution you not to gift too much. You don't want to be in a situation where you have gifted too much and you're not able to have the retirement that you want because of the fact that you've gifted so much of your assets. So you want to make sure that when you're making decisions, that you're working with your advisor to make sure that the decisions that you're making are best suit your needs, because you could actually end up costing yourself more if you're not going through the process correctly. Now, another thing that frequently comes up as far as conversations are concerned is joint ownership of assets. So what I mean by this is if you have an adult child, you can put your adult child on as a joint account holder on your non-registered accounts. And as a joint account holder, essentially what you can do is have them joint with rights of survivorship where beneficial ownership has changed. And essentially what that means is at the time that you add that adult child on as a joint owner, you're considered to have sold half of the account. So you own half of the account and the adult child owns half of the account. So from a probate standpoint, you've done what you wanted to accomplish. You've been able to avoid probate, and that account moves over to that adult child. Essentially what happens is your half of the account would still be taxable at the time that you pass away. But probate tax has been avoided. Now, there are three issues I want to bring to your attention as far as this strategy is concerned. The first is now that adult child owns half of the account. So if you happen to go through a marriage breakdown, if the adult child goes through a marriage breakdown, their half of the account is included as family property when that equalization calculation is being done. If that adult child has creditors, their creditors can seize their half of the account because of the fact that, that it is considered their account for probate purposes. Their account as the beneficial owner. The third issue with that is if you want to make any changes on the account, that adult child does need to sign off on any changes. So as you're going through all of your planning process, you want to really make sure that you're making decisions that best suit your needs and that you're not simply trying to avoid probate. Now, it looks like there may be a question from Catherine Wang. Catherine, did you have a question you wanted to ask? Okay, so I'll just continue on. Now, when we're looking at the registered plans, as I mentioned, generally you want your spouse to inherit those because your spouse can inherit them on a tax deferred basis. So it's only when the second spouse passes away that that tax liability would apply. Now, another thing to think about is with respect to your RESP account, so your Registered Education Savings Plan. So if you have an RESP set up for a child or a grandchild, maybe a niece or a nephew, if you are the only subscriber on that account, you want to give direction in your will as to who you would like the new subscriber of that account to be when you pass away. And the reason is because many people think that the RESP belongs to the beneficiary. It actually belongs to the subscriber of the account. So if you're the sole subscriber on that account, essentially that forms part of your estate, and your executor has every right to collapse that account and distribute the proceeds of that account to your beneficiaries, the beneficiaries of your estate, who may not be the beneficiary of that RESP account. So there can be children who thought that they had money available to them to attend post-secondary who don't actually have that available to them. So if you're the sole subscriber on an RESP, you want to give direction in your will as to who you want that new subscriber to be. Now, with respect to the tax-free savings account or the TFSA, If you have a spouse, you want your spouse to be the successor holder on that TFSA. And the reason is because it is most tax efficient for them to be set up that way. As successor holder, your spouse inherits the entire account tax-free, and they can put the entire amount into their TFSA without the need for TFSA contribution room. If, on the other hand, your spouse were set up as a beneficiary, they inherit the account tax-free up until date of death, but any growth from date of death until the date that they receive it would be taxable to them. And if they wanted to put that growth in their TFSA, they would need TFSA contribution room for that. So that's why if you're looking for the most tax efficient way to have this set up, you would want to have your spouse set up as the successor holder. One question that comes up frequently is, can someone other than a spouse be successor holder? They cannot. It is only a spouse who can be set up as a successor holder on a TFSA. Now, a TFSA is an excellent account type and one that is not utilized by a lot of Canadians. In order to be eligible for a TFSA, you must be age 18 and be a Canadian resident. But it's not like an RSP contribution where you have to have earned income in order to be eligible for the TFSA. Everyone who's 18 or older, has a valid social insurance number, and is a Canadian resident is eligible for the TFSA. So currently the TFSA contribution limit is $6,000. If you have been eligible since 2009 and you've never opened a TFSA, your contribution room you would have available is $75,500. Now, the reason why the TFSA is so fantastic is because the contributions are made with after-tax dollars, but any growth in the TFSA is tax-free. When you make withdrawals from the TFSA, those are also tax-free. And what makes it even better is January 1st of the year after you make a withdrawal, you get that TFSA contribution room back. So this is a great account that you can use as a rainy day fund, use it for purchases, maybe for travel. It's something that a lot of people also use it as a way of supplementing retirement income because of the fact that this is tax-free money. So lots of uses. And if this is something that is of interest to you, please reach out to Cherry and let her know. Now, what this is showing you here is this is showing the difference between the successor holder and the beneficiary. So as you can see, if your spouse is set up as successor holder, they inherit the entire line. So the green line and the blue line tax-free, and they can put the entire amount in their TFSA without the need for TFSA contribution room. But if your spouse were set up as a beneficiary, it's only the green line that they inherit tax-free and can put in their TFSA without the need for TFSA contribution room. Any growth from the date of death until the date they receive it would be taxable. And to put that in their TFSA, they would need TFSA contribution room for that. So I wanted to now talk a little bit about probate, because our team gets a lot of questions about probate and what it is and what the cost is and that sort of thing. Essentially, probate is simply giving the executor the ability to be able to settle your estate. Now, there is a fee that's associated with this process, and I'll talk about the fee in a couple of slides from now. Now, with respect to the calculation, it's based on any assets that are flowing through the deceased's estate. So if you have non-registered assets, whether those are invested in stocks, bonds, mutual funds, those are going to flow through your estate, and those will be subject to probate. If you're the last person on title on real estate, that will be subject to probate as well. Any jewelry that you have, art collections, coin collections, automobiles, all of that is going to form part of your estate, and all of that will be subject to probate as well. If you have registered accounts or life insurance policies that either don't have a beneficiary designation or have the estate as the beneficiary, those are also going to flow through your estate and be subject to probate. So let's see on the flip side, what is excluded. If there's a mortgage on your real estate, the value of the mortgage is subtracted from the fair market value of the property before the probate calculation is done. If your registered assets and your life insurance policies have beneficiary designations, those are going to pay directly to the beneficiaries. They will not form part of your estate, and as a result will not be subject to probate. As I mentioned earlier, if you have any joint accounts that are joint with right of survivorship or beneficial ownership has changed, those will also not be subject to probate. Those will go directly to that joint account holder. Now, a question I get a lot with respect to joint ownership is with respect to your principal residence. So after the first spouse passes away, people frequently ask me whether an adult child should be added on title on that property. And generally, I would say they should not. And the reason for that is because in Canada, we have something called the principal residence exemption. And what that means is that we do not have to pay capital gains tax on our principal residence. Now, if you add an adult child on title and that adult child does not live with you, what happens is that you've lost half of your principal residence exemption for the amount of time that that child has been on title. And when I look at the way that property values are increasing in the GTA, you could definitely cost the estate a lot more by trying to avoid probate than what that actual probate fee would be. So why don't we look at what that fee is? If the estate is less than $50,000, there's no probate that would apply in that situation. Anything above $50,000, it's 1.5% that's charged in probate. So if we're looking at a $2 million estate, it's $29,250 that's charged in probate. So is it something that we would prefer not to pay? Of course it is. But in the whole scheme of things, it's not a huge amount. And that's why I was saying that you could actually cost yourself a lot more by trying to avoid probate than what that actual probate fee is. Now, probate used to be a very simple process. Essentially, prior to 2015, all an executor needed to do was make an application to the Superior Court of Justice in Ontario. They would state what the value of the estate was as a whole. They would sign an affidavit to that effect. And then they would pay probate on that amount. There were no valuations that were required, no appraisals, no supporting documentation. But what the government found is that they were missing out on a lot of probate dollars. They were finding that executors were underestimating the value of the estate so that they didn't have to pay as much probate. So they decided that they needed to change the process, and that's exactly what they did January 1st of 2015. So first thing that they did is that they transferred the administration from the Attorney General to the Ministry of Finance because they felt the Ministry of Finance would be more likely to be able to collect those probate dollars. The next thing that they did is they now require that an estate information return be completed for all assets that flow through the estate. Now, to put your mind at ease, assets can be clumped together. So all jewelry would be on one estate information return. All art would be on one. So they can be clumped that way, but essentially all assets need to be captured on at least one estate information return. Now, if it is found that the executor provided fraudulent or misleading information, they can be charged up to 2 times what the probate tax payable would have been. And in severe situations, the government has the ability to imprison the executor. Now, rest assured, I have heard of no situations in the past 6 years where an executor has been imprisoned, but if the government feels it's warranted, they have the ability to do that. Now, their idea behind these estate information returns is that it's going to make it a lot easier for them to audit the estate if they feel that it's warranted. Now, what kind of information is included on that estate information return? First and foremost, there's information as to who the deceased is, and then information as to who the executor is. So the government knows who to contact should they have any questions. And then, as I mentioned, any assets that flow through the estate are going to be included on that estate information return. So on the flip side, what is excluded? If there's real estate outside of Ontario, that would not be included on the estate information return for Ontario. If somebody received a CPP death benefit, that would be excluded as well. And then, as I mentioned, any assets that flow outside of the estate, those are not going to be on this estate information return. Now, we get a lot of questions about an RESP. So as I mentioned, a lot of people believe that the RESP belongs to the beneficiary. It does not. So if the beneficiary passes away, it would not be included on the beneficiary's estate information return. If there were joint subscribers on the RESP and one of the joint subscribers passed away, it would not be included on their estate information return. Now, if the individual was the sole subscriber of that RESP account, then it would be included on their estate information return. Now, this is slightly different than the RDSP, or the Registered Disability Savings Plan. With the RDSP, this does belong to the beneficiary. If the beneficiary passes away, it would be included on their estate information return. Now, as far as filing this document is concerned, it needs to be filed within 180 days from the executor receiving the probate certificate. If the executor is made aware of additional assets after they filed the estate information return, they have 60 days from when they become aware of the additional assets to file an estate information return for those assets. Now, the government, the reason why they have this document is so that it's easy for them to audit the estate. They are allowed to audit the estate for 4 years if they feel there are no issues with the estate. If they feel that there was fraudulent or misleading information that was provided, they can audit the estate indefinitely. So very important to make sure that as an executor, you're holding on to all of these records for at least 4 years, just in case you get audited. Now, a question I get a lot is whether probate is always required. And if nothing is flowing through an estate, then probate would not be required in that situation. Or if the estate is less than $50,000, it wouldn't be required there either. But in my experience, normally probate is going to be required. I would say 9 times out of 10, you're going to find that probate is going to apply. So the next area that I wanted to focus on is to consider the tools to fit the situation. So as I mentioned by this, we're talking about wills and trusts and powers of attorney. One thing to keep in mind is, I briefly mentioned this at the beginning of the presentation, but business succession planning is extremely important. You want to make sure that you're thinking about who you want to have take over your business. Because as I mentioned, so many business owners that I have encountered throughout my career have been very focused on running the business on a day-to-day basis and haven't really been thinking into the future. And you want to make sure that you're setting up the individual that you want to have take over your business and make sure that they're ready to take that over when you're ready to step away. Now, when we're looking at the will is the cornerstone of your estate plan. It's in your will that you are going to indicate who you want your beneficiaries to be, who you want your executor to be. If you're setting up trusts, the trustee is named in your will as well. If you're philanthropic and you want to make a charitable bequest upon your death, that would also need to be included in your will. Your executor does not have the ability to make a charitable bequest on your behalf if you have not specifically requested that in your will, or if you have not put the charities as beneficiaries on your registered accounts or your life insurance policies. Another area that is a tool that is fantastic as you're going through this whole process are testamentary trusts. And the reason why testamentary trusts are really great is because it's essentially allowing you to delay distribution of assets after you've passed away, and also to control those assets after you've passed. So I'll give you a few examples as to where you may want to consider using a testamentary trust in your plan. So as I mentioned, I have two minor children. In the event that something happens to my husband and I, we have trusts set up for the children. So essentially, they get X amount of dollars at 25, another chunk at 30, and the balance at 35. If they want to pull money out to attend post-secondary, they have the ability to do that. If they want to put a down payment on a home, there's a certain amount that they can pull out for that as well. So we've just set up these trusts as a way of protecting the children from themselves. Now, you may be saying to yourself, I don't have minor children. I don't see a use for testamentary trusts. Maybe if you have a young adult that is going to be a beneficiary of your estate, you may want to set up a testamentary trust, again, just as a way of protecting them from themselves, ensuring that they do not spend all of their inheritance too quickly. If you have a beneficiary who has dependency issues, whether it's alcohol or drug dependency issues, maybe somebody's a spendthrift. This is a great way to protect them from themselves as well. Another use of trust can be with respect to somebody who's disabled. So if you have a disabled family member or friend who is part of your estate plan, you may want to set up something called a Henson Trust for them, which is a fully discretionary trust. And because the beneficiary has no control over those assets, it does not count as an asset when you're looking at their provincial disability benefits. So that might be something to consider as well. And if any of this is resonating with you and something that would be of interest, please reach out to Cherry and she can discuss this in more detail with you. Now, in the event that you don't have a will or that your executor cannot find your will, in that situation, you're considered to die intestate. So before I got into this role, I just assumed if something were to happen to me and I didn't have a will, that my husband would inherit my estate, but that's actually not the case. So he would get the first $350,000 of my estate, but anything above that, 2/3 would go to my minor children, and 1/3 to my husband. My husband has no say whatsoever in how the children's assets are managed. And as soon as the children turn 18, they would get full access to their inheritance. And in my experience, generally an 18-year-old is not in a position to be able to inherit a large sum of money. Now, where I find intestacy in Ontario to fall short is with respect to common law spouses. So a common law spouse is not considered a spouse for intestacy purposes in Ontario. So if you're in a common law relationship or you know someone who is, it's even more important in that situation to ensure that you have a will so that you're the one who is determining how your estate is going to be distributed. Now, the next area I wanted to talk about is choosing the people to speak for you. So these are your powers of attorney and your executor. So I'll talk about powers of attorney first. So essentially in Ontario, we have two types of powers of attorney. There's a power of attorney for property. So this is the person who makes any decisions as far as your assets are concerned. And then there's a power of attorney for personal care. And that's the individual who makes decisions as far as your housing, if you're hospitalized, those sorts of decisions. So let's look at the power of attorney for property first. So this individual can do everything that you yourself can do, except they cannot write a will and they cannot change beneficiary designations. But they can purchase property, they can sell property, purchase and sell investments. So this individual has a lot of power. So you really want to think about who you feel would be right for that particular role. And you can have different powers of attorney for personal care from powers of attorney for property. So you really want to make sure that you're choosing the person that would be best suited for that particular role. The other one is the power of attorney for personal care. So I've had many people say to me that they feel that they do not need a power of attorney for personal care. Their spouse was recently hospitalized and the doctor took direction from them without asking to see a power of attorney for personal care. I hear that frequently, but technically the hospital should have been asking to see a copy of that power of attorney for personal care. You do not want to be in a situation where you are being asked to produce that document and you don't have it, because at that point you have to go to court. The court has to appoint you as a power of attorney, and it can slow down the process as far as getting the care for that individual. What we're finding is when you are going to have your wills drawn up, more and more lawyers are prompting you to have a power of attorney for property and a power of attorney for personal care drawn up at the same time. So that's the next person that you would have speak for you, is the executor. So for the executor, if you have 5 children, I highly recommend not having all 5 children as executors, because everybody needs to work together. Everybody needs to sign off on everything. So it can really slow down the process if you have too many individuals as your executors. So generally you would want 1 to maybe 3 people as your executor. Now, if you have 2 individuals who don't get along, I highly recommend not having them as co-executors. After I did one of these presentations, I was approached by a woman who said she and her sister were co-executors of her mom's estate. And I said, oh, that's very common. She said, oh, no. My sister and I don't get along. And my mom thought this was a great way to bring the 2 of us closer together. As you can imagine, there was nothing further from the truth. It took a very long time to settle that estate because the sisters just couldn't agree on anything. Now, when you're thinking about executor, think about proximity. And what I mean by that is, if you can find somebody in the same city or town as you, that's ideal. The same province is helpful, but the same country is a bit of a necessity. Now, it's not a legal requirement to have a Canadian resident as your executor, but if you have a non-resident as your executor, that individual needs to get bonded. So essentially, that's additional insurance that the estate needs to get on that individual for them to be able to settle the estate. The larger the estate, the more expensive that bond is going to be. So that's why, if it's at all possible, you want to try to find someone local. Now, you may be thinking to yourself, you're thinking about your friends and your family, and you can't think of anybody that would be up for the role. In that situation, you may want to consider going the route of a corporate executor. And that's generally done through a trust company, and they would be able to help. And we're finding that corporate executors are becoming more and more common these days. Now, the next thing that's really important is to—
Hi, Jacqueline.
Yes.
Hi, this is Rebecca. I'm an advisor from SoCo. Hi, thank you for the presentation. But I have a question. Like, this is a question I heard a lot. It's back to the point 3, chosen people you would like to speak to for the power attorney for health. A lot of people nowadays, they have more than 2 kids. Like, what if they don't have one? Because I heard there's complications might happen if you have multiple kids. And if you don't have the power attorney for house, they might somehow need to go through all of them or something. Like, can you explain that part a little bit more detail?
Yes. So essentially what happens is, if you don't have a power of attorney, then there's no one there who's there to speak for you, essentially. And then what happens is that you have to have a court document, like you have to have a legal document as the power of attorney. So what would happen is that those children, either one of them or all of the children, would go to court to be appointed as the power of attorney. So it really slows down the process. And if the parents need medical attention, you don't want to have that process slowed down because of not having that power of attorney. So that's why you want to have those powers of attorney set up as soon as possible, so that if you ever need that document, it's there and can be utilized at that point.
But what if they don't have it? Would they call individual child to get it? Because that's what I heard from one of the nurses, because I dealt with one of my clients. They said they're gonna have to call every single children. Yeah.
I haven't heard of that previously, so that's highly possible, because I guess they need all of the children to agree
Right.
on what the steps going forward would be.
Yeah.
And if you think about children being overseas
I
and
know
different
that was the right.
time zones and that sort of thing, that can be very problematic, and that can really slow down the care of the parent. So yeah, Rebecca, to your point, like it's even more important in those sorts of situations to make sure that you have that.
Great. All right. Thanks for that. Thank
Thank
you.
you. Now, when we're talking about communicating your wishes, you want to make sure that you have communication, because when you don't have communication, that's when the legal battles can start, and that's where issues can arise. So I'll give you an example in my personal situation where communication, I believe, is going to be helpful. So essentially, my mom has two children, my brother and I, and we're the sole beneficiaries of my mom's estate. My brother is a restaurateur. So several years ago, he opened a restaurant, and he borrowed a substantial amount of money from my mom to open the restaurant. And then he never paid her back. So essentially what my mom did is she changed her will, and it says that I get X amount of dollars off the top to make up for the loan that she had given my brother. And then after that, everything is split evenly between my brother and I. Now, my brother and I are extremely close to my mom. When she passes away, we're not going to be acting rationally. And I know my brother, and he would have said to me, "What did you do to mom as her executor to get her to give you that extra money?" So what my mom and I did instead is we had a conversation with my brother. We had a conference call set up, and my mom said, "Jackie's getting this extra money because of the restaurant." And my brother said, "Of course, that makes perfect sense." And he has no issues with it whatsoever. But if we had not had that conversation with him, that could have definitely caused some problems. So any communication that you can have through the process, I highly encourage it. I'm not suggesting that you tell people what they're inheriting or give them dollar figures or anything like that. All that I'm suggesting is if people are getting different amounts, or if there can be something that can be perceived as not being equal, having that conversation can definitely help, because when the legal battles start, the only person who wins out in the legal battles are the lawyers. And a lot of the time it causes massive problems between family members. So having communication and making sure that people understand generally what you're trying to accomplish, that can be very helpful. Now, the last point I wanted to talk about is just keeping your plan up to date. So anytime that you have any sort of a change in your situation, make sure that that is communicated. So if you're working with an advisor like Rebecca or like Cherry, make sure you communicate that to them. If you're working with a lawyer or an accountant, make sure that they know what's going on in your life, because you might think that this is a very small change, but this could have a ripple effect over your entire plan. So again, the more communication that you have, the better off the whole process would be. So that's what I wanted to cover today. Now, I know I've given you a lot of information in a relatively short period of time, so I'd be happy to answer any questions that you may have.
Well, terrific. Thank you, Jackie. That's very informative. So for all the audience, you can please either unmute yourself or type your questions through the chat box, and Jackie will be happy to answer that. Actually, Jackie, we do have one question here. So that's with regards to the TFSA. Okay. So if the wife has a TFSA, should she set up the husband as a successor or just beneficiary? And what's the difference?
Yeah, she should set up the husband as the successor annuitant. And the reason for that is because as successor annuitant, the surviving spouse inherits the entire TFSA tax-free and can put the entire amount into their TFSA without the need for TFSA contribution room. If, on the other hand, the spouse was set up as a beneficiary, it's only up until date of death that the spouse inherits that tax-free and can put it in their TFSA without the need for TFSA contribution room. Any growth from date of death until the date they receive it would be taxable to them, and they would need to put that, to have TFSA contribution room to put that in their TFSA. So yes, if you have a spouse, I highly recommend having your spouse set up as successor annuitant.
Great.
Hi, could I ask a question about TFSA as well?
Definitely.
Sure. Yeah, TFSA are great. It's great, but I oftentimes hear that the CRA is like playing the rules like depending on their needs. I mean, for example, like if I bought Tesla 100K in 2020 and it 10x, and then it becomes 1 million. So in 2020, before the end of the year, I withdraw 1 million from my TFSA. How much money I can recontribute in 2021?
Yep. So if you redeem $1 million out of your TFSA in 2020,
yeah.
January 1st of 2021, you get that $1 million contribution room back, in addition to the $6,000 that you got because everybody got $6,000 of TFSA contribution room. So, but then on the flip side, you said, what happens if it tanks? So if it tanks, like, so say your $100,000 investment went down to $50,000, and then you wanted to redeem that $50,000, you'll only get $50,000 of TFSA contribution room back rather than your initial investment of $100,000.
Yeah, so I oftentimes heard that. So if that's the case, you 10x your money in TFSA, like the CRA has a high chance that to come after you, say, hey, TFSA is just for like saving retirement purpose. You are speculating, you are getting 10x your money, you should pay your taxes. So does anyone hear about any examples like that? And how do we like avoid that? How do we like best utilize TFSA in that scenario?
Yeah, so you are correct. So they don't want it to be used for speculation. So if you're purchasing penny stocks or something like that in the TFSA, and your TFSA does extremely well because of that investment, we have seen situations where CRA has said that was not the intention of this particular account type, and they have charged people, you know, but that's more in situations where they feel that you're speculating or trying to go against what their intention was as far as that account. If you're purchasing, you know, regular stock, I haven't seen any issues with it. I'm really just seeing it with those penny stocks, and that's where people are being penalized.
Do they have a set in stone rules to say what are the what actions are okay, or what actions are deemed to like speculations? Like Tesla stock isn't like penny stock. They are including S&P 500. So if I happen to buy Tesla and tax my money and they come after me, like what should I do?
Yeah. So with something like Tesla, I don't think they would come at you. The only time that I've heard about it has been with the penny stocks. And it's just because that's more speculation, right? Because that's sort of the intent of those penny stocks. If you're working with one of your advisors, one of these ladies here, there's no issues with that. They're going to put you into an investment that best suits your particular needs. Those are not most likely, I would be surprised if those were penny stocks that they would be putting you into. So it would not be an issue that you would have. Where we're finding that people are having issues with their TFSA accounts, it's when they're doing the trades themselves, where they're not working with a financial advisor, and that's where issues can arise, because your financial advisors need to get a lot of information about you, make sure that the investments that they're suggesting that you invest in, or that they're working with you to have you invest in, suit your particular needs. So in that kind of a situation, those aren't the individuals that CRA is going after. It's really the ones that are trying to speculate and trying to grow that TFSA as quickly as they can. And that's where they have the concerns.
Okay,
Jacqueline,
thank you.
I think we have a couple questions in chat box. We can go through more detail about that. Yeah.
Great, Jackie. The next one is, what if someone passed away in a situation where the overall liability and debt exceeds the assets? Will the beneficiary be liable to kind of carry on the liabilities?
Yeah, so they are not. That is a fantastic question. So essentially, as an executor, the executor has to go through the process, sell all of the assets in the estate to try to pay that debt. But if there are not enough assets in the estate, not enough cash and property and that sort of thing, it is not the executor's responsibility to come up with that money individually. In that situation, the estate would be considered to be bankrupt, and then the executor would go through the process as far as filing for bankruptcy is concerned.
Great. And the next question is, what's the best way to store a will so it is safe and also accessible to the person at the time for the needs?
Fantastic question. So if your lawyer is willing to hold on to your will, that is ideal. But I'm finding more and more lawyers are giving the wills back to individuals. So what I'm finding a lot of people are doing is that they're purchasing a fireproof box and putting the will into the fireproof box, but don't lock the box. And the reason you don't want to lock it is in the event that your home is burglarized, what happens then is that the burglars will open the box, see it's your will, there's nothing they can do with it, and hopefully they'll leave it behind. But in the event of a fire, hopefully the will survives the fire. And the reason why you want the will to survive is because the executor needs to work off the original will. So that's why you need to make sure that that original will is kept safe.
Great, thank you. And the next question is about the trust. This can be a whole presentation alone. So if you can provide a high level kind of thoughts on what the process looks like, the key benefits, and maybe some problems people normally encounter.
Okay, so there are two types of trusts that can be set up. There's a testamentary trust. That's a trust that's set up as a result of your death. So essentially you would put a clause in your will as to what you want the parameters of that trust to be. And a lawyer would help you with the wording of that. And then essentially your will is then used as the trust document. So when it's set up as at a financial institution, that's the trust document that's used. As I was saying, you can use that for minors. Trusts work really well for minors, for disabled individuals. If you're in a second marriage and you want a spousal trust, those we're finding are becoming more and more common as well. Now, the other type of a trust is an inter vivos trust. So this is a trust that's set up during your lifetime. Why you may want to set up a trust during your lifetime is with probate, for instance, as soon as your will has been probated, that becomes a public document. So anybody can pay a fee and get access to your will. A lot of us are very private people and don't want people to be able to access our wills. So what a lot of people do is that they set up inter vivos trusts, and then they transfer their assets into the trust. So the trust owns those assets instead of the individual themselves owning those assets. Because that doesn't form part of your estate upon your death, it would not be included in your will and nobody would be aware of those assets. Now, the downside to this is that inter vivos trusts are expensive. So you have to go to a lawyer to have a trust document drawn up. So there's a cost for that. On an annual basis, there are trust returns that need to be done. Those can be quite expensive as well. A lot of the time you have to engage an accountant to help with that. Also, any income that's retained in the trust is going to be taxed at the highest, like at the top marginal tax rate. So that can also be costly. So you need to look at your situation and see, okay, what makes sense for me? Is privacy the most important thing, or is a cost savings the most important thing? And then determine what's best for you in that case.
Great, thank you. Without a power of attorney, does that mean the children cannot make a medical decision on behalf of the parent?
And that is correct. And that was something that Rebecca and I were talking about. And so if there's no power of attorney, then What Rebecca was saying some of her clients have encountered is that you actually need, the doctors need to speak to all of the children individually to make sure that everybody's agreeing with the decisions. And as we were saying, you know, with so many people being overseas in different time zones and that sort of thing, that can really slow down the process as far as care is concerned. So you want to have these power of attorney documents so that you don't have to go through that whole process.
Okay, great. So we have one last question here. How does executors get paid, or do they get paid at all?
So they can be paid. So the maximum that they can be paid is 5%. So it's 2.5% on the assets that flow into the estate, and then 2.5% on the assets that flow out of the estate. Now, generally, we find unless it's a very complex estate, you're not going to see a 5% executor compensation that's going to be charged because you need, as an executor, to justify, be able to say, this is all of the work that I have done, which justifies this cost that I'm charging. If you do want your executor to be able to pay, like receive executor compensation, I highly recommend that you write that into your will. And that way it's right there and none of the beneficiaries can contest it. It makes it much more simple. Now, as an executor, if you are taking executor compensation, that is taxable. So CRA is going to want their tax dollars on that executor compensation. So you need to include that as income on your tax return.
Great, thank you. And Jackie, for a couple, do they each need a will where they can make a joint will? And what happens in the situation of a divorce?
So each does need to make their own will. So you each have your own separate will. A lot of the time, like the way that my husband and I have it set up, because we're a first marriage, we have something called mirror wills. So I get all of his estate and he gets all of mine if I were to pass away. And then in the event that we pass away at the same time, then there are parameters as to the children receiving it and wills, trusts being set up for the children. So you do have to have your own separate document. It can't be joint. Upon death, you need to update your will because a will is not voided, not upon death, upon divorce, because a will is not voided upon divorce. So when you do divorce, you need to get a new will to ensure that the way you want your assets to now be distributed, that is the case.
Thank you. And Jackie, what's the difference between draft a will with a lawyer versus buying a package online?
Yeah. So the concern with buying the ones online is if you have a complex estate or if you have a lot of assets or assets in different countries, the online wills don't always include all of the clauses that you may need. And what can happen is that you can actually end up costing your estate more because certain, assets were not dealt with that should have been dealt with within the will. There are some situations where if something's not dealt with in the will and it is an asset, you can be considered to be intestate as far as that asset is concerned. And then you lose control over how it's distributed. So I highly recommend going the route of a lawyer. And that way it ensures that the estate is being set up properly.
Great. Does a spouse need the power of attorney to make a medical decision on behalf of the other spouse?
Yes, they do. Yep. And both the power of attorney for property as well as for personal care. Yep.
Okay, terrific. I think we answered all the questions now.
My husband has one question. He is also a client, so I'll pass to him to ask.
Hi, everybody. I'm an artist. Been an artist for about 20 years, and but it's not my principal source of income. It's not. So what if an artist has a personal collection, quite a sizable collection of his own personal works? Although I do sell them, I'm presently not represented by a gallery, and so there's no set value in terms of appraisal. How do we set a value for that on the will?
Yeah, so in that situation, you would have to find someone to come in and appraise them. So I'm not familiar with the art community I'm sure you would know where to find someone. And essentially they would appraise your collection as a whole, and be able to give you a value for that. And then you can go forward from there. And then that appraisal would have to be done again upon death, because a lot of the time when an artist passes away, the value ends up increasing as far as that collection is concerned. So then that appraisal would be done again upon death.
Okay. Okay, thank you.
My pleasure.
Hey, Jacqueline, just to extend on his question. So basically, if people who collecting all the coins and any type of material like that, that's what's going to happen, right?
Correct.
Correct. Yeah. Okay, thank you so much for your time and all the answering questions. It was really informational. Thank you so much, though.
My pleasure. Have
Thank
a
you,
wonderful
Jackie.
day, everyone.
Thank
Yeah,
you.
enjoying the rest of the weekend. Take
Thank
care.
you. You too.
Thank you.
Bye-bye.